What is the effective federal funds rate, EFFR? Imagine a busy night where banks are lending to each other just to keep their reserves balanced. The rate they agree on is called the effective federal funds rate. This rate shows the actual interest banks pay when they lend reserve balances overnight without collateral. It is calculated based on all these overnight transactions from the previous business day. The Federal Reserve Bank of New York publishes this rate every day, making it a key indicator for short-term interest rates in the United States. In the world of macroeconomics, the effective federal funds rate is very important. The Federal Open Market Committee, which meets regularly, sets a target range for the federal funds rate to help guide economic activity. The actual rate tends to fluctuate around this target but might not always match it exactly. To keep the rate within the desired range, the Federal Reserve uses different policy tools. One main tool is adjusting the interest it pays banks on their reserve balances held at the Federal Reserve. This interest acts as a floor, influencing whether banks are willing to lend overnight or hold onto their reserves. The Federal Reserve also uses open market operations, which involve buying or selling government securities. These actions help influence the supply of reserves in the banking system. Another tool is the Overnight Reverse Repurchase Agreement Facility, which provides a way for the Fed to temporarily lend money to banks at a set rate. The discount rate, or the interest rate the Federal Reserve charges banks for short-term loans, is also part of the toolkit. By managing these tools, the Federal Reserve can influence the effective federal funds rate. When the rate rises, borrowing costs across the economy tend to go up. This can slow down economic activity and help control inflation. When the rate falls, borrowing becomes cheaper, encouraging more spending and investment. This can boost economic growth and employment. The effective federal funds rate impacts many parts of the economy. It affects the interest rates on mortgages, personal loans, credit cards, and business loans. Changes in this rate can influence how much consumers and companies borrow and spend. Overall, it is a vital measure that helps the Federal Reserve steer the economy toward stable growth and low inflation.